what we're going to do is put into context where we are now, and it kind of puts the current COMEX-driven volatility into perspective. Now, the speculator-driven rally into the all-time highs, right here, encountered the second of two margin increases. Now, if you remember, we discussed the very odd situation long before we were suspecting there'd be some margin increases, but we were puzzling as to why they hadn't happened. Now, bear in mind, there'd been no margin increases since November 2024. And the first one came in on the 9th of October, and we drew attention to it. This is where we were recording exactly 2 weeks ago. And we drew attention to it, basically questioning why it had taken 11 months and a $1,550 rise in the gold price from $2,500 to $4,050 for the house to increase margin borrowing costs.
Global financial order is undergoing a major upheaval in decades. Hidden behind everyday market swings is an intense and purposeful power struggle between East and West. Besides commerce and technology, focused on world monetary domination, Beijing, Moscow, and New Delhi are quietly but slowly building gold arsenals. China has accumulated massive amounts of undeclared physical bullion since the early 2010s, preparing for a dollar-based system collapse. Many believe that moment is near. Recently, the geopolitical chessboard has changed drastically. Western nations' 2022 seizure of Russian reserves sent a striking message to non-Western economies. Politically neutral dollar assets are gone. Soon after, China and the BRICS intensified their attempts to avoid the weaponized dollar. A new Gold Sea monetary framework emerged, first through bilateral yuan trade settlements, then through gold-backed financial instruments that circumvent Western banks. These events have put huge upward pressure on gold and silver, the smaller, more volatile metal that has outperformed gold in every major bull market. Chinese strategy is precise and patient. Over a decade, it has taken physical supply from Western paper markets, creating massive reserves under the surface. Beijing may now challenge Western bullion pricing domination with the Shanghai Gold Exchange and its international equivalent enabling actual physical price discovery. A protracted shift toward physical settlement and Asian-led pricing could irreversibly undermine the COMEX and LBMA's gold valuation control. As this process intensifies, the dollar's purchase power, already undermined by decades of monetary growth, faces unprecedented pressure. This is a turning point for the U.S. Andrew Maguire, a prominent British whistleblower, and other analysts believe that Washington must revalue America's gold reserves to succeed, especially under the Trump administration's economic nationalism. A fraction of the dollar backed by gold might restore credibility and mitigate the repercussions from relentless debt accumulation and Federal Reserve-induced inflation. A move like this would shake gold and possibly explode silver. Maguire links energy market weaponization, the Fed's mishandled gold positions, and China and its BRICS allies' worldwide pushback in today's video. His analysis shows how the U.S. Treasury's secret actions have simply delayed gold's inevitable revaluation, which could be America's only hope. Stay tuned because what he'll divulge could change investors' views on gold, silver, and the currency. Like this video, subscribe to the channel, and enable notifications to never miss another deep dive analysis.
So we'll start with a look at where we stand following what looks like the exhaustion stage of this officially orchestrated COMEX 3-week top-to-bottom pushback against an out-of-control spec-assisted China-orchestrated BRICS plus dollar-to-gold de-dollarization escalation. That's what was happening. Part of that was being powered by the speculators. That's the part they targeted. So let's have a look at the charts quickly. In fact, stepping back to where we were just 2 short weeks ago, and that was right here. In fact, I'll drill down into the smaller chart. What we're going to do is put into context where we are now And it kind of puts the current COMEX-driven volatility into perspective. Now, the speculator-driven rally into the all-time highs, right here, encountered the second of two margin increases. Now, if you remember, we discussed the very odd situation long before we were suspecting there'd be some margin increases, but we were puzzling as to why they hadn't happened. Now, bear in mind, there'd been no margin increases since November 2024. And the first one came in on the 9th of October, and we drew attention to it. This is where we were recording exactly 2 weeks ago. And we drew attention to it, basically questioning why it had taken 11 months and a $1,550 rise in the gold price from $2,500 to $4,050 for the house to increase margin borrowing costs. And this is when they increased them at around $4,050. These are the future charts. And we refer to this illustrating that was basically added a 7% bump. So you could still borrow COMEX gold at a 95.75% leverage basis. Used to be 96%, so barely difference. So in other words, you could borrow gold casino chips and at that price. Then we saw the second one come in. Now, why did that come in? It was no coincidence here. That came in just as gold powered into its all-time highs. Now, the previous delay in raising borrowing costs for this entire move up to around about 4,050, the reason for it, and we did drill down into it, was because the house, that is the LBMA CME cartel, who were wrong-footed naked short gold, and any margin increase along this way would have forced the cartel to buy back shorts into a bid-only setup. They needed time for enough speculators to get on board for them to actually rinse out. Now, you can imagine what was happening into these highs, because this is where the BIS had squared its last 4 tons. Bearing in mind, that was $409 higher than the forced September close. So essentially, August close. So the end of September was squared $409 higher. So with 30 tons still to short cover into what was really a $600 per ounce rally, something had to be done to avert a full-blown derivative gold default. Namely, not to stand in the way of the gold price rising, but only to the extent of how many speculators could be sucked in long with the house 1-to-1 short against them. The optimum point arrived last Monday, the 20th. Now, this was just when enough ballooning, naked long open interest had been sucked in. And again, with the house taking the short side, now already planning these 2 margin increases and a bid pulled event. And as soon as that was announced, in combination with, and bearing in mind, these market makers have a footprint in both the COMEX and London. We're looking at the COMEX market here, the derivative market, in combination with some bid pulling, and these specs having sucked in naked long, they pulled the plug on these massive leveraged positions. And where did we go to? A complete gap close. And this margin increase here had increased costs to borrow by $3,000 per contract to $20,000 to run that contract. As I say, this was enough. These speculators are leveraged using the prior profits to continue to leverage. So this was a classic rinse out. And given enough speculators had leveraged themselves long using paper profits to add more borrowed gold to the limit, this margin increase, along with strategically timed pit manager bid pulling, this borrowing cost to increase was designed to trigger a self-fulfilling waterfall spec long stop ignition. So the subsequent full circle retracement, basically, of the 3-week rally, and it was a 3-week rally all the way to this point here, around about the 5th. And this can be summed up quite simply. A full gap close flush, with the speculators from the commencement of the October rally all getting rinsed out. And, as is always the case, momentums are always wrong at both ends of a move. And by definition, they don't like sideways action. So they were forced into a pillar-to-post rinse and immediately took the other side and bet naked short. So really, probably around about this level here, all the specs, the longs were pretty much rinsed. Then you've got a couple more come in.
Andrew Maguire outlines complex mechanisms, not just technicalities. They are the financial plumbing of a stressed system. Western monetary authorities are desperate to represent stability by creating and selling billions of dollars in synthetic COMEX gold contracts to lower prices. Yet the Federal Reserve's mismanagement of Treasury-linked gold assets, unhedged derivative losses, and reliance on speculative liquidity have created a high-risk environment. Gold demand, especially from sovereign and institutional buyers, remains high. The physical market is tugging one way, while paper markets are stretching another, which cannot continue. Against this environment, geopolitics matter. Gold and silver accumulation in China is no longer a side topic. It now underpins their DD dollarization approach. Beijing's monetary landscape has improved since the BIS's Basel III framework designated gold as a Tier 1 reserve asset. New physical exchanges allow the yuan to be converted into gold, accelerating its use as a settlement currency. Washington's options are shrinking as the BRICS alliance grows, and a gold revaluation, long inconceivable, is now inevitable. Maguire's next chapter examines how this process may proceed and its effects on global financial dominance.
Then these were fully naked short sales. So where we had ballooning naked longs driving the price higher, we've now had ballooning naked shorts doing the exact inverse and reaching its limits. This is a classic bullish setup. Now, just for reference, I'm recording this on Wednesday, and this is Wednesday the 29th, really just between the AM and the PM fix. So obviously, don't expect, and we've got FOMC coming up, you're going to see some short-term two-way action, but really, as far as we're concerned, it's more attractive now to take out the short stops to the upside than to try and sell, naked short sell gold lower. This also applies to silver, but we'll look at that in a minute. Now, momentums will be the last to know that the house is stealthily taking the long side of these borrowed short bets. And as we will see, this bid-pulled overshoot of real money physical support levels, it now places these speculators into the crosshairs for an upside rinse of their short bets. It's a complete inverse view to them getting long. Now, true to form, these directional momentum specs, who control some 85% of all the COMEX gold and silver open interest, and oil as well, pretty much gold, silver, oil, all pretty much controlling about 85% of it. They've borrowed gold from the house on the short side now. And this looks to have been playing out into what looks like the conclusion of a capitulative rinse. Now, with the house increasingly exposed to upside T+1 delivery demand, forced delivery obligations that actually are being loaded out, the house has to be on the long side of these speculators. They don't have the liquidity to just keep adding paper shorts, because it just literally forces delivery. Now, into this entire two-way spec flush, it'll soon be revealed that as yet unseen central bank, sovereign and institutional buyers are quietly converting a rising dollar. A lot of this has happened into a rising dollar. What do you think they're doing? They're saying, Yeah, while the automated spec sellers will say, hey, dollars rising, sell gold, dollars rising, sell silver. But what the real money is doing is saying, hey, we've got a rising dollar. Hey, what an opportunity to convert dollars into gold, into silver. So you're kind of sometimes seeing that correlation really breaking apart. So what this does is set up a competitive short stop rinse to the upside, setting up the next higher physically determined spec-free, I will add, speculator-free price to rally from before the next round of hot money sets itself up for a fresh long stop rinse again. Now, while this old school legacy market pushback is being orchestrated in sync with every media outfit calling gold a meme-like bubble, in reality, from a paper to physical perspective, we've been evidencing what is really a necessary and very constructive 96% leveraged long stop flush and an equally ballooning 96% spec naked short positioning. Now, the media has been likening this price smash to struggling to find some sort of parity to what's happened in the past, even though things have changed so rapidly. So they would likened it to the 3 year. They were talking about the 3 years ago, the 2013. Oh yeah, there was a $600 sell off from $1,600 to $1,000. Whereas in reality, the scope of this flush was 3 weeks. It's a 3-week gap close that's been limited simply to how many naked long speculators holding open interest could be sucked in before just simply pulling the plug on the strategically timed COMEX-centric margin borrowing cost increase, which by no coincidence came in double whammy as gold was rising. Now, this planted it's form-fitting. This kind of form-fitting mainstream media analysis illustrates that the mainstream media's lack of understanding of how dislocated the legacy gold and silver unallocated, unbacked, leverage price setting COMEX exchange has become versus the SGE, the Asian, the physical supply demand based price setting mechanisms that have evolved, and that very short term spec induced volatility aside, the COMEX is no longer in control of setting the global price of gold. Sure, short term. And we'll probably see more into FOMC today. Who knows? Doesn't matter. It's just really rinsing out all the froth. Now, what's missed by the majority of the legacy market analysts is that these are the people that pen pieces on Financial Times.
Andrew Maguire's investigation highlights years of financial overreach. With $38 trillion in public debt and trillions more in off-balance sheet obligations, the U.S. faces a credibility dilemma. To offset this with a Treasury-backed stablecoin without gold backing would be futile. The BRICS gold-backed digital settlement procedures have already weakened the dollar's dominance. Asian and Middle Eastern central banks are shifting from treasuries to bullion. Paper-based pricing systems in New York and London lose importance as this trend accelerates, shifting control to physical exchanges in Shanghai and Singapore, where settlement means delivery. The effects on investors are considerable. A U.S. gold revaluation, whether intentional or market-driven, would instantaneously price gold, silver, and mining equities. Silver, long restrained by industrial demand, may grow asymmetrically when monetary confidence declines. Silver has outperformed gold numerous times in previous revaluations. Given its supply shortages, its upside potential is huge. A downward dollar devaluation would cause a broad rotation into tangible assets. Formal U.S. gold revaluation would indicate tacit admission that the dollar cannot be the global reserve currency. A multipolar financial order with resource-backed currencies and bilateral trade systems would replace the century-old unipolar model. This would confirm China's decade-long effort to discreetly acquire gold while pretending to comply with the dollar. Investors face danger and opportunity. Future short-term dislocation risk. Real money asset revaluation opportunity. Gold and silver are affected by a systemic value recalibration, not only inflation or interest rates. The U.S. can deliberately revalue or be forced to by market pressure, as Andrew Maguire notes. The outcome favors intangible assets over paper pledges. The world is moving towards sound money. For those paying attention, the signs are clear. If this analysis was helpful, please like the video, subscribe to the channel, and comment below. Your participation helps us reach more viewers interested in the precious metals market's true drivers. Thank you for watching and stay tuned for more on the gold, dollar, and global finance conflict.